I get the feeling that we're going to start the year in a lower volatility environment, primarily because of QE. But as events hit the market, that the potential for spikes in volatility could be significant. We're up again 20% this year. What are the odds of having 20% plus years in a row are not high. So, that's going to be, there's probably going to be, as we get into the new year, more people wanting to hedge, which will cause volatility to rise on the margin. The Supreme Court is going to rule on tariffs. We know there's a midterm election. We know that the AI bubble is causing some angst. Japan, for instance, is talking about starting to prop up the yen. How does that affect the yen carry trade? So there's events that have the potential to spike the VIX. But right now the VIX is very subdued. It's probably not a bad place to buy some hedges if you want, because optionality is pretty cheap here.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap featuring my good friend, portfolio manager, Michael Lebowitz. Michael, how you doing, my friend? Happy holidays.
Doing well. Thank you very much, you too, and to everyone listening, watching.
Thank you. I hope everybody watching had a great Christmas, or in your case, Michael, a great Hanukkah there with your family,
Thank
or
you.
whatever holiday your family celebrates in the world, everybody. I am here probably on day one of not feeling like a total uh, complete invalid. I've been laid low by the flu. I tested, I had the influenza A strain. Today's the first day I feel actually semi-human, so I've got a lot to celebrate for that. I'm also on the road for the holidays, and I'm joined today by a co-pilot here, a very friendly cat who kept me company for the past 5 days while I was in bed. He decided he wanted to come join us for the interview, so I hope it's okay, Michael, if he sticks around.
Yeah, I'm allergic, but it shouldn't be a problem.
Okay, hopefully that doesn't go through the inner tubes. Look, lots to talk about this week. Um, and maybe we'll just sort of start where I think the interests are most focused by a lot of the viewers here, which is on the silver market. And you actually recently just wrote a piece about this, but silver and really the whole precious metals complex has just been on fire. In fact, it's gone vertical. I have a chart that I'll try to pull up in a moment here when I hand the baton to you. But really, gold, silver, platinum, they're all going straight up at this point. Silver on the morning, we're talking, I don't know where it is this second, but silver futures had crested above $76 an ounce earlier this morning. Bananas, I don't even really believe those words as they're leaving my mouth, given where silver was at the start of the year. And I know a lot of silver, long-suffering silver holders are rejoicing in this, as they should. Um, I do think there's an increasing danger that things have just moved so far, so fast. We're in this vertical phase that we talked about, Michael. These things generally don't end by going sideways. And certainly historically with silver, when it's gone vertical like this, and there have been a couple pronounced periods in history where it has, the retracement has been short, violent, and brutal. And I don't want to say that that's definitely going to happen here. I'm sensitive to some of the arguments that this is a repricing of a metal that has been, both manipulated and overlooked in the past, and there's some very real supply shortages going on right now. But I think it would be a disservice not to tell people that you want to have some sort of plan in place in case history repeats here.
Yeah, and we wrote an article about this, and the article talks about the fundamentals, and there are, you know, some valid reasons just fundamentally why the price of silver is rising. It's in greater demand. The data center race, the solar power, all use silver, and quite honestly, silver mining has been neglected. So you have years of a deficit in silver, and it seems to be catching up now. So you can make a fundamental case. You can make the case that you kind of made that it's catching up from years of being mispriced. We can make up a lot of um, facts to support the price. But there's one other fact that I think is potentially most important. And the fact that silver is an industrial metal used in some of this new high technology makes what I'm going to say even more critical to understand. And I'm going to just share my graph. It's a long-term silver graph. So this goes back to about 1970, and there's three obvious spikes on this chart. And to your point, Adam, it's had these amazing runs and a mirror-like decline, right? A classic kind of boom bust graph. And now here we are on our third boom since the late 1970s. Now, if you look at late 70s, early 80s, and 29 to 2011, there are some similarities there. They were in 1971, Nixon took us off the gold standard. The money supply started increasing. Inflation was starting to rage in the mid to late 70s. So, it was the dollar debasement trade at the time, and that the Fed was printing money, and some of the same themes we heard again in 2008, in the post-financial crisis. Look at what they did to bail out the system, how much money was printed, and the dollars going away. Very similar themes. And then you get to COVID, where they just threw every fiscal and monetary policy at the economy, at the markets. And in the aftermath, silver is once again climbing, right? Climbing significantly. So, the environments are the same, but I think what is most critical to understand is this graph. This goes back to 2010, 2011. This is that middle spike in the graph I just showed. And basically, what happened in 2011, what happened in 1979, 1980, was that the CME, the Chicago Mercantile Exchange, came in and drastically raised margin requirements, basically making it much more expensive for people using silver futures to buy silver or options to buy silver. And that was the marginal demand for silver, and it cracked. You saw the graph. The same thing 1979, 1980 was a little different. It was being squeezed by the Hunt brothers, and these three brothers were buying silver. Then they were starting to use silver on margin to accumulate more. And at the end of the day, both the CFTC and the CME came in and made it almost impossible to trade silver futures. Price collapse. So bullish, bearish, what I just urge everyone to consider is I don't care how bullish you are, if the powers that be, whether that's the CME, whether that's the government, whoever it is, could be the Chinese government, right? Whoever it is wants to put the price down. It's been done twice before, and it would not be shocking. In fact, I think it's just a matter of time till it happens again. So,
That's a great point, Michael. I really appreciate you doing this. So, right now the debate is about, for the bulls and the bears, it tends to be on the fundamentals and market elements, right? And what you're saying is hey, there's very important non-market factors that in the past have actually kind of been the the agent that has ended the party both times, where it's like, whether it's the cop showing up at the party or just the bartender refusing to serve any more punch, um, the alcohol can be taken away, even when the party looks like it's never going to end, if that's what the authorities decide to do.
and right. And earlier on, I said this has become a more important industrial metal. That's even more reason to do this, right? Now that these industrial metals are really starting to come into the focus of the governments, not just our government, the Chinese government too, that they are incented to keep the price down. The other reason to keep the price down from the government's point of view is that soaring gold and silver lead a lot of people to believe that the dollar's in real trouble. The dollar's being debased or the dollar's going away. So that's silver is kind of the anti-dollar, and silver going up means there's no more trust in the Fed or the government, all that kind of thing. So That's another reason why the government might want to squash the precious metals as a whole. Um, I just shared another graph here that just shows the current rise is very similar to 2009 on a percentage basis, depending on where you want to start it. Uh, and just the rate of ascent is very similar too. And I don't have it on this graph, but similar to the late 70s as well.
Yeah, and we're even higher now, at least on a MACD basis, higher extreme than we were back in 2011.
Yeah, I mean, some of that is price too. So some of that is mathematical, but yes, we are. And you can see the RSI at the top is more or less at its peak. Those on its own argue for a correction, not a trend and a trend change. So, it's not a stretch to say that gold could go to 50, 55, right? Correct, normalize kind of supply demand and then start going higher. What concerns me, and that from a technical perspective, that would be a concern. That's a reason to either hedge, take some profits, trade accordingly like you would any other asset. What would scare me is the CME or the government um, coming in with a drastic action that will knock the price down so quick that you don't even have time to get out. Um, so ask yourself if you own silver, what is it, 70 something today? And
Yeah,
if
like
we
I
come
said, the
in
silver futures, last I checked, were had just bounced over 76.
76, right? So I made this graph a few hours ago. It's wrong. So ask yourself, you own silver, you're high-fiving, your friends today. You come in Monday morning and it's 62. What are you going to do? What if the CME came in, drastically changed margin requirements? Are you going to sell then? Maybe, but it's gotten beat up. And that's why you have to be kind of proactive with some of this stuff. And given that you have this outside, this isn't just a market story. The CME or the government can really take this down quickly. So all I'm saying is, I'm not saying sell all your silver and take your profits. What I am saying is you may want to think about hedging. You may want to think about taking profits. And, it's just prudent trading. And, we do that all the time with stocks, with bonds, with everything else. Silver's no different.
Yeah, so that's a very consistent theme on this channel, which is, rebalance. Don't get too greedy, right? What is it? Pigs get fat,
Pigs
hogs
get slaughtered.
slaughtered. Yeah. Um, so let me ask you this, and folks, this is not personal financial advice. Talk to your financial advisor about whatever step you might take here. But what's a little bit different about investing in precious metals versus many other assets is there's a physical aspect to it. And there's a lot of people that are buying these metals for sort of long-term protection against fiat power debasement, right? And
Mhm.
so I'm sympathetic to the person who says, okay, look, I bought a fair amount of silver, let's say, and I hold a good chunk of that in actual physical ounces. And I don't want to sell those because yeah, Michael, you might be right. The price might actually retrace maybe even a fair amount in the near term, but I'm going to hold this for the next 5, 10, 15, 20 years. And I believe down the road, then it could be worth a lot more nominally than it is right now. So I don't want to sell it, but yeah, I'd love to not just ride this correction down if that's what happens in the near future here. So what would be some potential hedges to look at putting on there that don't require you to sell your physical ounces, but you can still benefit if the price pulls back from here?
Options. The problem with put options at this point is they're going to be very expensive because of the volatility.
Hmm.
Um, the
And
one
I'm
of the
just curious,
things
like price of options on an ETF that just tracks the
you
silver
could
price
you
on
could do it on SLV, for instance. I'm actually using the silver ETF, which is actually why the price on my graph was a little different than
right,
silver
right,
futures.
because they don't map. Yeah,
That's what it was. It wasn't that I was that out of date.
yeah.
So you could buy a put on the silver ETF. Maybe you could buy a put on the gold ETF. There's a little basis risk that silver and gold don't move together, but generally they will and do move together. But that's the problem is when you get to extremes like this, the cost of insurance is very high. It's like uh, buying house insurance in the middle of a hurricane.
Right. Or
You can buy it. It
buying
ain't going to
fire
be cheap
insurance while
though.
the fire's crouching in on your house. Yeah.
Right, right. Um, so, you have to decide what you are. Are you a pure trader? Are you a hybrid trader investor? Or are you just long term, you don't care? Maybe it'll go to 90, maybe it'll go back to 40 on its way to 200. And you don't care how it gets there. You're thinking about where it's going to be, 10, 20 years from now. And that holds true for every asset. What are you? Define what you are and what you're not. If you're buying futures, you are not a long-term investor. If you're buying physical gold and putting it in your vault and not thinking about it, you don't even really know how many ounces you have, you're a long-term holder for whatever reasons you may have, and that's fine. They're all fine. Just know what you are in your own head.
Okay. There are other things that one could buy put options on that will move when silver moves. Could be silver miners. It could be a levered silver ETF or fund.
Hmm.
Again, not personal financial advice. Some of those will move more than others. Probably the cost of those will vary as well, given the prices of the premium right now on the options. I guess my main question, Michael, is if somebody is trying to think through this in real time right now, could they reach out to RIA and say, can you guys kind of help me think through this and come up with the appropriate hedge for me, given my personal position and my risk profile?
As our clients, if they own silver, we'd be happy to help them. We have to know someone's full financial position. It's not giving good advice if we're just commenting on one little part of their
Right.
pie. So, if you're a client, absolutely let us know. We'll be happy to help you out. If you want to be a client, let us know. We can talk through it. Lance, you did mention silver miners. And one of the interesting things is that silver miners have not been keeping up with silver. Typically, you would like to see silver miners doing better in silver. It's a leverage bet on silver.
Right.
Just like silver is kind of considered a higher beta version of gold, and it's been doing better in gold here. So you would like to see the higher beta versions of various things doing better, and it that silver miners have been keeping up with silver. They've been doing well, but not keeping up, and that's just something to be aware of.
Well, what does that suggest to you? Does that suggest to you that they're about to slingshot higher, or is it a tell that says, hey, if the miners aren't really taking off here, then that's the market thinking this rise in silver is maybe going to be transient?
It suggests to me that this is a very speculative run here, led by futures, led by hedge funds, led by a lot of people that typically don't own silver or that don't care about silver as an insurance hedge that see an asset going up in price.
Hmm. And how
That's what
much of
it,
it too is the fact that this is happening? I mean, silver's been white hot for a good while now, but this week it's gone bananas. This obviously is the Christmas holiday week. I mean, the pros are kind of out of the game, right? I mean, this is mostly just retail pushing stuff around at this point, correct?
yeah, but a lot of the big institutions will use these times to they have more relative strength than they typically would to push markets. So you can make the case that some of them are pushing, and if you wanted to short it this afternoon would be a great time. We're recording Friday noonish. Come in the afternoon when liquidity dries up. Like I think on Christmas, actually my son told me this, but Bitcoin traded down to like 25,000.
What?
Yes. A flash crash kind of trade. It didn't, work its way down, but there was a trade around 25,000. The point is that during periods where it's very illiquid, and we're going to have some of those next week as well, that that you can push less liquid things. Silver certainly qualifies as that. So, maybe someone tries to push it to 100 next week. Maybe someone shorts it, tries to get it down to 40, 50, whatever. So, just be a little extra careful to what happens in these illiquid markets.
Okay. And look, we'll move on from the silver topic here. Just two things. One, I did say I would show This chart, I don't think you can really see the numbers here so clearly, folks, but you can see the verticality that I was talking about across all the elements of the precious metals space here, gold, silver, and platinum. And I think actually, as of today, platinum futures are now up more for the year than silver futures. So platinum has now taken a pole position here. Um, and again, all Michael and I are trying to say here is that this type of price action rarely resolves by trending sideways. I would love it if it did as a silver, of a holder of all these. I'd love it if it kept going forever. But I just am enough of a student of history to recognize this shape here in the charts and realize what usually comes next. So, obviously, folks make your own decisions here. But I have been saying a lot during the rise of the precious metals this year that hedges are always a wise thing to put in place. I have been happy that the hedges that I have bought, I didn't need them. Made way more money with the continuation of the trend, which makes me glad that I just didn't full on sell out. That I was, using hedges as opposed to just selling big chunks of my position. But Yeah, I mean, for all the reasons Michael and I have talked about here, if you were just continuing to be naked long in here, it's fine. That's your choice. Just be aware of the risks.
Right. And the risks are also outside of the typical fundamentals. That's what's a little more concerning. So yeah, just if you feel the need, protect yourself.
Okay. All right. So let me ask you a question I asked your buddy Lance last week. Um, so, I asked him just straight up, do you think that 2026 will be the year of disinflation? And the main reason why I asked that question was because not only are we seeing inflation as measured by CPI continuing to cool, and I think the latest numbers that just came out kind of caught a fair amount of folks by surprise that CPI dropped from about 3 to what, 2.7 or something like that.
Yeah.
Yeah. But as you guys have been saying at REA for a good long while, by far the biggest factor in the calculation of CPI, the headline CPI number, is shelter costs. And for a good long while now, you and others have been saying, those are very lagging inputs into the CPI calculator. And if we look at the more real-time inputs, we can see that the housing market is cooling, that an increasing number of parts of the country, not only are housing prices disinflating, but they're actually deflating in a growing number of markets. And rents are actually starting to deflate too. And so that is going to bring down the shelter component in the CPI. And because it's 40 some odd percent of the calculation, that's going to drag the rest of the CPI down with it, almost irrespective to what the other inputs into CPI do. So Lance's answer was basically like, yeah, I think it's going to be a year of disinflation. Do you agree?
Yeah, the other part of it is goods, tariffs. How are tariffs impacting things? And assuming tariffs don't change, you get the impact of the tariff. However, that's passed on to the consumer, but there aren't additional tariffs. So
Right.
let's just say
As
there's
we
a
talked about, it's more of a, it is proving to be, it looks like it's proving to be more of a one-time price shock versus a
right,
sustained inflationary pressure. Yeah.
exactly. So yeah, I tend to agree that I think we will be in just a slow grind down to the Fed's 2% target, which should provide the Fed more comfort to either cut rates or not cut rates, but focus a little bit more on the health of the economy and the labor market, which right now are diverging pretty rapidly, but I suspect that won't be the case.
Okay. So, anything that in that scenario where the Fed has to worry less about inflation and says, hey, we can start giving a little bit more love to the weakening jobs market, that does seem to argue that more cuts would continue from here. So is that your expectation?
I think so. I mean, right now the market's only pricing in one cut
I
for the
know.
entire year. I'd be shocked if that was correct.
Okay. So
Now,
you're going to take the over?
well, I'm going to say they're going to cut, yeah, more than that.
Yeah.
But, a year is a long time, and there's going to be a lot that's happening this year. So, don't be surprised if we're sitting here a year from now and say, I told you I was right. They cut three times. And then you say, no, you were wrong because then they raised it 4 times.
Hmm.
So, kind of looking out over the next 3 to 6 months, I do think that assuming inflation, that last CPI number was a little difficult to swallow. It was included part of the period where the government was closed.
Yep.
There wasn't full pricing of every good. Surveys weren't working. So what I want to see is where is inflation come February when we get, another month or two of data to
Hmm.
really tell us what's going on there.
Okay. I mean, we'll see that, but one of the things that has turned in inflation is, and look, we just got to parse the difference too between low inflation, even 0% inflation, right? Doesn't mean lower prices.
Mhm.
It just means flat prices, 0% inflation,
Right,
right? So everyone is saying, look, my groceries are still really expensive. It's like, yeah, well, until there's actual deflation, your grocery prices aren't going to come down, right?
right.
Um, but what drove I think the majority of inflation over the past couple of years was services,
Hmm.
right? And services are actually disinflating now, right?
For
So
the
that
most part.
yeah, so the inflationary pressure has, I think we had good initially. It was goods were disinflating, some deflating, but services were continuing to rise, and that was
Right,
driving inflation. That was making it so sticky. We've turned the corner on services inflation, but then we had the tariffs, and the tariffs pushed goods inflation back up again. But the big question was for how long, right? Was it going to be this one-time shock, or was it going to be persistent? And I think we're beginning to see it probably was more or less of a one-time price shock. And of course, as more of these, trade deals get struck, in most cases, tariffs only have to go down, right? Unless countries, back away from the table and Trump gets angry with them again. Um,
right,
so, you know, if services inflation was proving more sticky, I would think, okay, you've got a better chance to say inflation is going to be more sticky next year than folks are or than folks are beginning to argue right now.
right.
So I don't know. I mean, I again, I think it comes back to with think status quo being the same with everything else. Shelter prices should drag CPI down. Now, that how much relief are we all going to feel from this? I don't know, maybe none. But
Right.
just in terms of the number that everybody uses to base policy off of, it seems like that number is going to go down next year.
Right. There's another factor too. I think affordability is what's going to determine who wins the midterms.
Yep.
It's always the economy. Um, so affordability, and Trump knows this, right? So Trump in his mind and his team are like, what can we do to get inflation down by September, October, so that when voters go to the poll, they're going to want two more years of a Republican Senate, House, leading the way. So I think there's incentive. There's a lot more incentive this year than last year to do things that can impact towards lower inflation. So it's another wild card. You also have the tariffs. What if the Supreme Court strikes the tariffs and the tariffs go away? Now that they'll be implemented in some other way, but maybe not to the full extent. So there are other factors too, in addition to, what you said, services and goods and rent and all that stuff, that favor lower inflation.
So I've got this earmarked for us to talk about, and actually part of the rant I was going to go into is going to talk about this, but maybe we should just bring it up here. So the reason why I started with inflation here was because I wanted to get to your thoughts on bonds. Um, but let's talk about what you just mentioned and put it square on the table. Um, this is the year of midterm elections. They typically don't go well for the party that's in charge, right? Um, and I had talked with Lance a lot, maybe even with you a fair amount, right when Trump had gotten elected, was, my advice to his administration was, man, let this economy tip into recession. Like just like let all the natural market forces that want to happen, and you can just blame it on your predecessor and hopefully you can get through it within a couple of quarters, maybe a year, right? But by the
Mhm.
time you're coming out of it, hopefully it's maybe the beginning of the year of the midterms, and so you've got positive forward momentum going forward. You've gotten rid of the froth and a lot of the stuff that just needed to be put behind us. And yeah, it would have been painful, but again, you could have blamed it on Biden, and you could have now been showing a lot of positive momentum going into the elections, and that I think would have been the best ticket for saying, "Hey, keep me around, right? I'm making things
Mhm.
better." Right now, Trump's got to avoid this economy dipping into recession, which he might, and that's one of the questions I want to ask you here in a moment. Um, uh, but I'm with you, Michael, which is unless the economy is booming and people can vote on kind of more higher level, almost kind of luxury causes, everybody basically pulls the lever based upon how their pocketbook is feeling.
Right.
And so, are we going to get a chance to, does the administration have enough runway to make things materially enough better for enough people to try to hold on to this, hold on to the House or hold on to the Congress? I guess I'll ask you that question, but I got a bunch of follow-up questions for you too.
Well, I guess here's the problem. The economy is booming. We just had 4.2, 4.3% growth in the last quarter.
Right, but
That's
it's a
that's
very lopsided boom.
exactly. It's the K-shaped economy, and there are very few that are benefiting from that and a lot that are suffering.
Right.
So
Because you
that's
remember, the poorest person, their vote counts just as much as the richest. Right? It's one of the great things about
yeah.
America, right? Yeah.
Right. Not every other country, but this country.
Yep.
So the question is, how can you make the economy broader based? And how much is just the AI data center build out and the new technologies feeding GDP? But that money spent is benefiting so few people. So that's the challenge, I think, for Trump, for the Republicans to keep the two houses. But generally, I think the economy will slow down next year. Um, it's kind of hard right now to see a recession because of that data spending growth. It's just buoying the economy, even though spending, I think, will fall off next year. Christmas holiday spending seems to have been decent. A lot of it was on savings, on debt, on
Buy
other
now, pay
things that help
later.
buy now, pay later. That propped it up. People have prioritized holiday spending, but at the expense of January, February, March, April, May. So it'll be interesting to kind of look back and when we get to June and see how lopsided the spending was into the holidays and then pulling back as we get in through the first few months of 2026. Sentiment, consumer confidence, those numbers are at recession lows, and the University of Michigan is almost at an all-time low. The Conference Board consumer number is at recession lows. So clearly there is a problem that consumers are not happy. And at the end of the day, there has to be a correlation between your consumer sentiment and consumer spending. And I think that is somehow going to converge next year. Does sentiment improve and spending, justify spending, or does spending come down? And again, consumer spending is two-thirds of the economy. So
Right.
it's a big part of the puzzle.
So, I've channeled the administration a couple of times, in recent videos, and not that I have any insight, insider insight to them, just based on what they say publicly. And they would say, "Hey, Michael, look, we have been laying the groundwork for an economic renaissance in this country, and that's what all last year was about. This year is where those pistons start to fire." Right. And so don't count us out, man. In fact, there's going to be an increasing tailwind from all the things that we got passed in the one big beautiful bill and the deregulation and all the money we're bringing in here and the tariff revenue and the reshoring of jobs and, factories that we're having, foreign players build here and all that stuff. Right. And I can see that if they are successful in that's going to make a difference. Right.
Absolutely.
And kind of like I think elections in almost all cases just come down to how people are feeling. And I think in almost all cases, how people are feeling is a function of how easily they feel they can get a job. And the job market has cooled, substantially. And there's a lot of hiring freezes, and we've seen, more layoffs and stuff like that. So that's on the bad side. If the administration can be successful in increasing the job supply, and I don't mean necessarily with government jobs. That was sort of the approach of the last administration. This administration's actually tried to shrink the size of government. But if all of a sudden there's a lot more jobs out there for people because they were building all these data centers, or because we have all these new manufacturing plants starting to come online and whatever, that could be a meaningful factor in here. I don't feel like I've got enough visibility into this. I just feel like it's going to be a race to the finish. Yeah, I don't know which way it's going to go.
Right. I mean, unfortunately, I think the building of the data center is a lot more labor intensive than the managing of the data center. So, and then the question of how many foreign plants are really going to be brought to the US. We saw this in his first term, where a lot was promised and not a lot was delivered because it
Hmm.
doesn't make sense, economic sense to build a lot of things here. So, the question is how many promises to do stuff will translate into jobs.
Right, but that's
And
what the tariffs are for, right? Is there to make it make economic sense, right?
we'll see.
Yeah.
And are the tariffs even enough to make it make economic sense? And if you're a company, the tariffs are nice, but Trump's going to be gone in 2.5, 3 years. And will those tariffs go away? And now are you stuck with a plant in the US without the benefit of tariffs when you should have just stayed in wherever you were? So, a lot of that, and then of course, you have the Supreme Court weighing in on tariffs. So, I think it's a difficult decision to move a plant to the U.S. and bank on tariffs. And even if the tariffs are in place for the next 2 or 3 years, what will the next president do?
All right. All right. Well, look, if indeed it is, you know, not achievable in this time frame we're talking about here, then it gets tough.
Hmm.
As I said, this is my personal point of view, so I'm totally open to being wrong here. But I think at the end of the day, it's all about jobs, and the trajectory right now of the labor market is not good. And so, if that trajectory continues unabated, I see it real hard that it'll be really challenging for the administration to hold on to Congress.
Yeah, and one of the bigger problems I see is that the ones it seems to be hitting the hardest are the younger people, the people in their 20s, early
Yeah.
20s.
Their
They
unemployment
just
rate right now is horrible. I mean, it's very
Right.
quite recessionary.
Right. I mean, so many of my daughter's friends are just they can't they have jobs, but they're not jobs they went to college for.
Yeah.
And I think that's a big problem. That explains why Mondami won in New York. It explains why AOC is popular. That these people want something different. You know, is socialism the answer? Probably not. No, but they want something different than what we have, and we've seen that time and time again. Obama ran on change. Trump one ran on change. Biden didn't. He ran on the same thing. And then Trump too ran on change. We're demanding change from the economic system. So we'll see. We'll see how the big beautiful bill and tariffs and everything else the administration has done can it resurrect the economy, change the economy, increase jobs. But that takes a lot of time. And there's a midterm in 9 months or so, 10 months. Is that enough time to change the voters' minds? And if not, if you have a split Congress, that creates a lot of problems for the administration trying to get stuff through.
Yeah. Um, and look, I'm not a political analyst here, so a lot of this is just guessing. But obviously, I think that's why the one of the reasons why the administration moved so fast right out of the gate this
Right.
time was saying, look, we got to get as much pushed through in case we lose the Congress, that at least we got enough of what we care about in to carry us through the next 2 years. Um, What could make a difference here, and again, I'm not a political analyst, but a headline that came out right before we hopped on here, Michael, was that the murder rate in the U.S. Dropped, I think, by a record amount over the
Mm.
past year. Not to a record low, but dropped by a record percentage year over year. And I think that's the one thing that can, pardon the pun, trump the economy in an election is security. Is if people, if their biggest problem is fear for their own safety, if you can provide enough relief on that, that's something that people might use to keep you around. I don't know if that fear is as widespread across the country as people's concerns about the economy. But if further progress is made on that, that might be another factor that uh, might come into play here.
I mean, I think though, like you, it's your paycheck. Where's the next paycheck coming from? That's what's driving votes. How much money do you have in the bank? It's economics. Um, and that's what's going to drive the economy. And it's being kind of billed under this affordability index. And the one thing that Trump really has going against him is that the price level of goods, not the change in the price level, but the price level just reeks of heavy inflation.
Yeah,
Even though the price may have stayed the same, price of eggs has gone down, I assume, over the last 9 months, 6 months. It doesn't matter. It's that sticker shock
right. People can
when you're
still
going
remember
out to
what they
dinner.
used to say. Yeah, that's the
Yeah,
problem.
6, 7 years ago, and
Yeah,
that's the problem. And it's almost going to be even if we had disinflation, deflation, negative growth rate of inflation, I'm not sure people will believe it because the price level is still very high.
right.
So it's really an uphill battle for Trump, and it's probably going to be an uphill battle for the next president until we kind of get acclimated to this new price level.
All right. Well, I'm gonna come back to this whole you know, the unnatural acts that might be pulled out on both sides
Right.
in a midterm year when we get to the rant, and we'll keep it a very short rant this week. But let's get to where I was planning on going through this discussion about inflation, which was bonds. So we haven't had a bond update on this channel in a little bit. So it'd be great if you could quickly provide one or at least your general outlook on where you think they're headed. But my guess is, like your partner Lance, you expect yields to go down next year as inflation expectations go down.
Yeah, bond volatility, bonds and bond volatility are really low. They're really just drifting around, going nowhere. All of the stories that we started the year off with, the bond vigilantes and talking about the fiscal problems, all the problems facing this country have kind of vanished, right? We've had good auctions, we've had bad auctions. They sparked very little reaction in the market. CPI data sparked little reaction. The unemployment data is not really causing the bond market to move a lot. So I think what the bond market is kind of, you've taken that negative sentiment out, right? The bond vigilantes have kind of been silenced for the time being. Maybe they come back, but I think everyone's kind of waiting to see what happens with inflation. And if inflation does, continue to trend lower like the last report, that kind of paves the way for bonds to trade lower with or without the Fed cutting rates. Um, Part of the problem with bonds now is all the financial assets that are going up 20% a year. Who wants to own bonds when you can buy the S&P and you make 20% a year?
Right.
So I think part of when you talk about bonds is what's going to happen to the stock market, what's going to happen with Bitcoin or precious metals, because those are alternatives. We also have QE entering the market. So there's a lot that will determine where bonds go, but I generally think they will drift lower in potentially a very boring fashion where you don't really see it day to day, but you look back a few months and you're like, wow, they're down 20 basis points or, maybe down 0.5% or more over the course of a year, barring any kind of shock to the markets, to the economy, to Fed policy, to whatever may happen.
So, Michael, I mean, in the past couple of months, we've had the Fed cutting rates. We've had the Fed stop QT. We've had the Fed start QE, even though it's unwilling to call it that.
It's QE.
Um, yeah, we've had the disinflation that I've been talking about become a little bit more apparent in CPI and stuff like that. Why is the 10-year not budging?
It's found its right level. It's found its fair value that the supply and demand is just comfortable at that level. That's what assets do when they find the right price. They just kind of grind around and go nowhere. That you see it in volatility. Bond volatility is down sharply. It's just at that comfortable level where supply and demand are just offset well. Um, there's that's it's a very comfortable place. The problem is after periods of very low volatility, you tend to get spikes.
Mhm.
So the
But
question
I
is,
guess my question is if you expect that the fair value of bonds is actually lower going into next
well,
year.
yeah, I'm not saying the fair value, the market's fair value, where the market is just has found an equilibrium between the supply and demand has been relatively constant. Right? The silver market is the exact opposite of that. There's no equilibrium between supply and demand. There's so much more demand than there is supply.
Right.
And
Yep.
that's why, it's surging and you're going to see, even if it's going to 100, you're going to see 3, 4, 5 point moves up and down because the supply demand mismatch is so off. Bonds, you found a great middle ground. And that's where the market deems fair value. Doesn't mean that's where I think fair value is. I think fair value is lower from here, but that's where the market thinks fair value is.
Okay. So in your opinion, what do you think is going to lead the market to start adopting more your point of view than what it has right now?
I think it's going to be lower inflation. I think potentially weakness in the financial markets where people are driven to the safety of a 4% yield.
Okay.
Um, there's a lot of things that can cause it. There's a lot of things that can cause yields to spike. Those bond vigilantes haven't gone away and they haven't changed their views. So, part of the problem is when you're talking about where bonds are going to go, a good chunk of it is inflation. What's inflation expectations going to do? But what's very hard to predict is how's sentiment going to change? So inflation can go lower, inflation expectations can go lower. But if once again, we're running massive fiscal deficits and there's a couple bad auctions, and then all of a sudden everyone's worried that how's the government going to fund their debts? Yields can go higher. So, that's the balancing machine that we have to work through. And it's gauging sentiment in any market is very hard to do. But right now, sentiment seems to be okay, right? It's not scared anymore, right? You're not seeing these massive moves off every bond auction and every piece of fiscal news and whatever else it may be. So as long as sentiment kind of just stays rooted, bonds will follow inflation, which, should drift lower. But again, predicting sentiment over longer periods, over 3 to 6 months is going to be very difficult. And that's why, going back to silver and gold, that's the problem for the Treasury and for the government is that if you were to look at the gold and silver price, you would say there's something wrong with the US fiscal system, right? And they're very aware of that. So again, that's why they are incented to keep a lid on
To
gold and
try
silver,
to
and that's
yeah,
being nice.
yeah, to try to pound those down. Although, of course, all my fellow precious metals holders would say, well, there is something wrong with the fiscal system in the US government. All right, I'm going to move over to the center now that my co-pilot just left.
He got bored. I don't
Yeah.
blame him.
No, he's just really long sober and he doesn't want to hear anyone
He's
tell him
had enough of
that he
me.
might end. Yeah, exactly. Enough of your doom and gloom. All right. Well, look, I don't know if you're able to pull up the latest TA on stocks, but maybe we can migrate quickly from bonds to stocks and just talk about first what you know where things are right now in the markets, which I think is still elevated. It's probably a kind way to say it, but we've been trading back at all-time highs for the most part with equities. You talked about one of the things that could start driving yields down in the bond market would be trouble in the equity market. I'd be curious to hear what your kind of top contenders for that would be, but I got to imagine one of them would just be the bloom coming off the AI rose.
Yeah, so let me go through. I have the technicals up on the screen. Maybe we'll go through those first.
Sure,
You see them, right?
I see them.
So, the I know if I let you keep talking, the two things you would say on this graph are the continued the way the MACD and the RSI are setting lower highs, right? They're
Negative
continuing
divergence
to just,
there. Yeah.
yep, they're continuing to trend lower with various buy and sell signals along the way in the MACD, but trending lower. And I created a little box. We've really been consolidating for the better part of 2 or 3 months now. Um, the moving averages have been very good guidance, whether it's the 20 day or 50 day. So the good thing is it's hard to see on the graph, but the last day or two we hit record highs. So in theory, we've broken out of that consolidation box, but not by enough to really say we're going much higher from here. Market was down when we started this, so we're probably right back into that box. But on the margin, your MACD is not that high. Your RSI is at 60. That's close enough to fair value. And you are setting new highs. So that's positive. One of my themes for next year is valuations. And the problem with valuations is they're incredibly difficult to trade off of. They're outstanding at telling you how the market returns will be over long periods of time, but over short periods, they're very difficult. Valuations are extremely stretched. So looking ahead, is 2026 the year that they correct themselves? Or is 2026 1999 and they get even more stretched all over again? So, as you trade the market next year, valuations should always be top of mind. Doesn't mean you should sell, doesn't mean you should buy based on valuations. It means you should be aware that there's a potential for a stormy environment if and when valuations will correct. The question is, will they in February? Will they in May? Will they in December? Or won't they this year? Is that a 20 or next year? Is that a 2027, 2028 thing? And it very much well could be. So that's the one thing I would kind of keep centered in your mind. The AI bubble, some call it, we don't really know if it's a bubble yet because some of these companies are seeing earnings off the charts, right? Nvidia. Some of these companies have very reasonable, dare I say, cheap valuations, PEG
Right.
ratios.
Assuming the revenue streams are sustainable, and that's
Assuming the revenue growth is sustainable.
uh,
And what makes it difficult about this technology is it's changing so rapidly that the technology that's working today may be a completely different technology 2 years from now, and all this invested money may be for naught. Or they're on the right path, and these companies really, NVIDIA is a cheap company. We don't know, right? So I think sentiment around the AI bubble is going to be of utmost importance to the market. And we've seen it for the last few months. All of a sudden, companies are having to go to the debt markets. No longer is cash flow enough or borrowing from other people in other companies in the industry enough to keep funding themselves. We're seeing what we see Meta and Google, I believe it was, or Microsoft, come to the market for bonds. Oracle, same. Oracle CDS. Everyone talks about Oracle's credit default swaps that are trading like junk now. So how does that story play out?
right.
And
And
as
just sorry
these,
to interrupt, but we're seeing sentiment shift in this space. It has gotten more sour over the past couple of months, and we're seeing it even in the funding, where Oracle, a great example. I think you had Blue Owl, who was going
sure.
to buy a tranche from Oracle, who passed on it, right? Um,
Mhm.
but what's interesting is you can't just you got to be careful just trading off headlines and things like that because this is a game that's changing in real time, and we just saw. what was it with OpenAI? I think it was. The Saudis just came in and put a big chunk
Right,
in there, and I don't know, but something tells me that the administration was probably pushing them hard to do so. And so even if kind of US based players might be losing their appetite for this debt, there may be some additional safety or white knights that could ride to the rescue internationally if we're, basically
right.
grabbing them by the throat and say, hey, if you want X over here, you got to do Y over here.
Well, here's the problem with the Blue Owl news. If that news would have come out July, no one would have cared. No one would have thought twice about it. But it came out when there's kind of these heightened concerns,
Mhm.
tensions in the market, and it had a bigger impact on Oracle. So, you know, the market right now is sensitive. Its sentiment is sensitive. So news is gonna, on the margin, probably be more negative than positive. And that's when we talk about environment like valuations, what's the environment in the AI space right now? And I think it's one of caution. So keep that in the back of your mind as well, that bad news will probably be amplified a little more than good news. And that will change and it can change, but that's the environment that we're in at the moment. And that will, the problem is that these companies are so big and their market caps are such a big percentage of the S&P 500 that it's driving the entire market. So that's something to be sensitive about as well.
All
Now,
right. Go
now,
ahead.
now there's a huge tailwind though too, Adam. QE.
Yep.
QE is a massive tailwind. The Fed is now providing the markets with liquidity. Is it enough? We don't know. They just started doing it, so they're building up the coffers. Um, but there is a high correlation between many asset returns and the amount of liquidity the Fed is pumping into the market. So you have a couple negatives, valuations are potential negative. The current sentiment around AI is on the margin, a little negative. QE is a positive, and every week I think they're buying roughly 10 billion more. So it's slowly adding to liquidity. Um, so that's just something to keep in mind. There's a lot of different factors that are driving sentiment, that are driving liquidity, that will impact the markets.
Let me ask you this, because this will go into the rant a little bit. What are your expectations for volatility next year?
Funny you say that. I actually did a volatility graph.
Hey, folks, I swear I didn't know he'd done this. That wasn't a softball, an intentional softball.
And the reason I did it is because volatility, I made that dark line at the bottom, is now at the lowest level for 2025. And you can see it kind of dipped below those August, September lows in the last few days. Um, now part of the problem with volatility is it's year end. Markets kind of get illiquid at this point of time. Volatility tends to decline. So some of it is just seasonal. But I get the feeling that we're going to start the year in a lower volatility environment, primarily because of QE. But as events hit the market, that the potential for spikes in volatility could be significant. We're up again 20% this year. What are the odds of having 20% plus years in a row are not high. So, that's going to be, there's probably going to be, as we get into the new year, more people wanting to hedge, which will cause volatility to rise on the margin. Various news events that we know are coming. The Supreme Court is going to rule on tariffs. We know there's a midterm election. We know that the AI bubble is causing some angst. The yen, Japan, for instance, is talking about starting to prop up the yen. How does that affect the yen carry trade? So there's events that have the potential to spike the VIX. But right now the VIX is very subdued. it's probably not a bad place to buy some hedges if you want, because optionality is pretty cheap here if you have concerns going into the first quarter of next year.
That's actually a pretty good idea. When things are at extremes, uh, if they're extremely expensive, you usually want to stick away. If they're stay away. If they're extremely cheap, usually you want to buy because your risk of downside is low. We've had other players, sorry, other experts on this channel of late predicting higher volatility next year. One of them was sort of Mr. Volatility himself, Jim Carson, and he thinks that every portfolio should have at least sort of a hedge, 5% hedge, just betting on volatility in it. And I imagine right now, because the VIX is the lowest it's been in a long time, betting on an increase in volatility right now is probably pretty darn cheap on a relative basis, right, Mike?
Yeah, I mean, this graph is really just a graph of the price of insurance. That's kind of the way to think about it. And it is cheap. So it's telling you that options are cheap. It's if you do hedge and you want to hedge, it's something worth looking at. Obviously the question is how long do you hedge for? What do you hedge with? There's a million other questions that accompany that, but it is something to consider, especially at these low levels of
All right.
volatility.
And obviously, again, that's a topic that RIA can help investors think through, correct?
Sorry. Yeah, absolutely. Absolutely.
Okay. Um, all right. Well, look, I'm so glad you actually had that chart there. So uh, I think you said something I've been saying an awful lot, which is that it's rare to have four even good years in the market straight in a row. It's we've had three great years now. So to expect a fourth, you've got probability working against you here. Sounds like you think next year will likely be a volatile year. Um, do you have a strong sense as to whether you think it's going to be a up year or down year?
I don't. You know what? We were talking a year ago, and I told you this was going to be the year of the roller coaster.
Hmm.
And we started off going up and down. It was a nice ride at first, and then for the better part of the last 6 months, we've just been on a nice
Yeah,
glide higher.
it's kind of like a
So
kind of like a big check mark year, right? We went down, but then boom.
right, right. So and actually, if you remember, January we had the deep seek debacle for a day or two.
Hmm.
Remember, that was January. April, we had the Liberation Day mess. But then ever since then, it's been smooth riding. Um, my guess is that whether we could be positive, but I wouldn't expect another 20% year. It would actually be healthy if we were up 3, 4, 5, 6%. Um, but again, there's a lot of news that will unfold. I can give you 10 bullet points of things that will happen throughout the year that we know, but there's going to be 10 more that we don't have any clue about. Or we can't even, like the Epstein files. Is it a non-event or is it going to take down various parts of the government? Um, there's, what's China going to do with Taiwan? Will they do anything? And then Adam, there's things we can't even begin to, will the UFOs land and change the way we think about things? I
Right.
mean,
The things that will be true black swans. There's just things we don't
right,
see
right.
coming. Yeah.
I mean, who had Venezuela on their bingo card, even in October, right? Things happen. Um, so at this point, I think we should expect be conservative on returns, especially where valuations are, especially with the AI bubble, the sentiment is not as good in the market leaders, the big caps. This could be the year where just those that are really adept at value rotation really win, right? If you can kind of beat the market's kind of going nowhere, maybe returning something like the bond market, maybe this is the year where if you know how to shift between value and growth and this sector to that sector and small cap to large cap and vice versa, this is the year where you can outperform versus basically the mindless, just buying the largest five stocks and sitting on your hands and go and play golf, right?
Right.
This may be the year where you actually need some skills to have decent returns.
And another way to say that is this may be a year where active trading or active investing will potentially uh, well outperform passive investing.
In theory, yes,
Yeah.
but said that
Okay.
for a few years.
No, I know, but for the reasons you said, if you're correct, then yeah, you kind of need to be active to stay ahead.
Mhm.
Um, all right, so I'm going to start wrapping things up here. I'll get to the rant, which will be real quick. Trades. Have you guys made any trades over the past week? I think Lance said last week that you guys largely were kind of set for the holidays, but you tell me.
We did in our all-weather portfolio. We sold down our silver and our gold miners back to their model weight. So we started that portfolio in August, and silver started at a 3.5% position. It because it had outpaced just about everything else, it became a 5.5% position. So we sold it back down to the model weight. Gold miners, they didn't get quite as high as silver, but similar concept. We're taking profits. We've basically put money, we've taken that money. We still have the same percentage we want, but we basically, if silver gets crushed over the next month, our net position is still in decent shape. And this is the same thing we did in some of those AI stocks or crypto that, had these magnificent runs and then have since been crushed.
Mhm.
So it's just prudent trading. It's not our way of saying silver's going to 20 in 2 months, but it's our way of,
Yeah, it's
you know,
following your discipline, which is great.
exactly. That's exactly well said.
Okay. All right, that it for
That's
trades?
it. Yeah, it was a quiet week.
Okay. All right. All right. Well, look, just to start to bring things home here. So, all I want to say about the rant, and Michael and I have already sort of touched on the message that I want to deliver here is, um, again, not having talked to Michael before we started to record to this, my gut has been telling me that there is likely more volatility to lie ahead. And why? Some reasons Michael and I have talked about, some other ones here. As Michael said earlier, a four-peat for the markets is unlikely. Having a fourth great or even good year in a row is just unlikely. So, as I said, you've got sort of statistics against you. There's also, we didn't talk about this much, Michael, but I'm sure you've got some feedback on it. There's just too much correlation amongst assets right now in the market. Kind of almost everything is going up at this point in time, and that can feel great. Certainly, when you own things, but tight correlation means there's very little place to hide if prices start going in the other direction. This is why folks like Jim Carson, who again also is predicting more volatility ahead next year, his whole approach is investing in truly non-correlated assets, which are hard to find in today's market, but they are out there, and that's sort of what Jim's specialization is. Another thing that Michael and I kind of talked about is that the world is increasingly sort of fracturing geopolitically. The U.S. is really retracing, right? It's pulling itself out of things like its involvement in organizations like NATO or whatnot. It is looking much more in towards itself, towards this Monroe Doctrine 2.0 that we've talked a little bit about. So looking at the Western Hemisphere. Europe is militarizing. Russia and China are increasingly flexing. And so, we're seeing this sort of change of the guard here, right? Where, countries are increasingly saying, okay, let's place less importance on old alliances, and let's figure out what we need to do for our own best interests going forward. And when that happens, there's just a lot less predictability because you don't know what each country is going to do because they're not going to follow the same playbook that they've been following. As Michael and I talked about, we've got elections here in the U.S. in the midterms, and I think it's a pretty safe bet that both sides, both political parties, are going to increasingly do whatever it takes to try to have the midterm elections go their way. And so when I'm just thinking of this soup that I just described there, It reminds me, Michael, I don't know if you know the song by Randy Newman, Great Nations of Europe Coming Through, but
I
it's
don't.
pardon me?
I don't know it.
Yeah, I mean, it's a funny song. I mean, it's a bittersweet song, as most of his songs are, but he uses a lot of cutting humor. And he basically talks about, all the destruction that the great nations of Europe had on the world, largely in the 16th century, because they just had their eyes on certain prizes, and they just kind of bulldozed everybody in their way to go after those prizes. And I think that's kind of like the environment we're going to find ourselves in here. One of his lyrics there was, hide your wives and daughters, hide your groceries too, great nations of Europe coming through. Basically just meant like, just get out of the way because if you stand in the way of these great parties, you're just going to get bulldozed into the dirt. And I think that's the danger potentially of next year. Again, one man's opinion. I'll let Michael talk in just a second. But I think in an environment like this, you really want to focus on protecting your interests, certainly when it comes to the markets, protecting your money. Um, at a more societal level, it's just keep those you love close, to the extent that you can provide shelter and protection. Make sure the ones you really want to have under your umbrella, you're getting under your umbrella. Expect surprises. Just literally expect to have things happen that you didn't plan for. And as Michael and I have already touched on a couple ways here, this is a time to buy insurance. This is a time to have hedges in place in case things go against your primary strategies here. To me, it just feels and smells like a year that's coming where defense and prudence and protection is going to have a higher premium on it than it's had in the past 3 years. So, Michael, I'll take a beat here, but what are your thoughts?
You know what? As you were kind of talking there, I kept thinking about our friend Neil Howe
Hmm.
and the fourth turning. And, we're just increasingly getting closer to the turning, to 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 this point where we've seen generational type news events and world events that happen. And you expect things to get more volatile from a, political, economic, geopolitical point of view as we're kind of nearing the end of this cycle, going to the next cycle. So I would definitely go back and listen. You've had him on multiple times, I believe, one fairly recently. But
A
just
couple months ago, he's coming on first week in January though, so he'll be on again soon.
yeah, and look, he'll be the first to tell you he doesn't know how it plays out. He wrote a book on it, but he doesn't really know how it's going to
Two
play
books.
out. But two book, well, one on how it's actually going to play out. The first book, The Fourth Turning, is just a history lesson on here's what happens over and over and over again throughout society. His second book was here's kind of things to look out for, and here's how it potentially could play out. So you know what, that we talk about valuations, right? That's the environment we're in. We're in a risky environment in the stock market just purely because of valuations. Well, we're also in a risky environment because we're just getting closer to that fourth turning and the pivotal events that will occur. Those pivotal events could be very bullish. They could be very bearish. But you have to understand that the volatility around those events, around many other things that are happening, will probably increase over time, and that will force its way into the financial markets.
Right. And when they do, when things really start moving faster and the stakes get higher and higher, um, people start making decisions. How do I say this? It's trade-offs. They're just trying to make the best trade-offs in the moment, right? And so it's like, okay, what can I do that will help more people than it hurts, right? And
Mm.
so the the decisions become less. You get fewer of the decisions of how do we do this where nobody gets hurt, right? And it's like, oh, how do we just manage what's going on here to hurt the least amount of people possible? And that's kind of the message I'm saying here is so you want to put yourself in as much position in advance where you can be the least affected by this as the wrecking balls of history as it starts getting rewritten here going forward, start swinging, how can you make sure that you're the least likely to become collateral damage in that?
And I think the easy answer is don't be passive. Don't, and it's not, it's investment wise, but it's everything wise. Don't be passive. Understand that change is always here, right? It's things are always changing, but the propensity for more change coming down the pike is higher than normal. So with your investments, be a little more active thinking. Don't feel like you can just ride this escalator up 20% every year. That's just going to be this nice ride. And if you want to play the market a little, buy a dip. That's not the way markets historically work. We've been gifted this kind of easy market. And typically, easy markets are followed by difficult markets. And so just be active in not just the markets, but your life and hedging all kinds of risks that come down the pike.
Fantastic. All right. Well, look, Michael, you've given us a great amount of time on your holiday week. So appreciate you stepping in here while Lance is taking his wife to a extremely well-deserved, nice little Christmas break. Lance will be back with us next week, folks. I think Lance and I are going to be recording on Thursday because the next day is his wife's last chemotherapy treatment.
That's right.
We're almost through the gauntlet, and things seem to continue to be going about as well as we can hope. So let's all continue to send him and his family lots of warm wishes and prayers for that. But Michael, I so appreciate your friendship. I'm looking forward to seeing you at RAA's event in
That's
Houston.
right.
What? That's next
That's right.
month, right?
It's in I should know the date, right? January 17th-ish. It's the weekend of Martin Luther King's holiday weekend, birthday.
Okay. So yeah, so it'll be just be a couple of weeks until I see you there. And then folks, if you want to still come join us, if you still have any tickets available, Michael, they can go to
There are.
realinvestmentadvice.com and there's a banner at the top of the site there, right? That they can learn more about the event.
Exactly. Yes. Yes. So come join us. We have quite a few speakers this year. It'll be a little bit longer than it was the last few years. Admin will be there. I'll be there. Obviously, Lance will be there, and we have a lot to share. Should be interesting and dare I say fun.
Oh no, it'll be fun. They're always fun, and I like the changes that you guys made for this year. It sounds like it's going to be even more social and a little bit more interactive. So that's
That's
awesome.
right.
All right. Well, look, folks, please join me in thanking Michael for spending his holiday Friday with us here by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. And obviously, if you would like some help in some professional help in figuring out how to position your portfolio to ride through 2026, whether it looks like Michael and I think it may, or whether it unfolds a completely different way, you want to make sure that you're as well positioned as possible for whatever may happen. If you would like that professional help and would like to get it from one of the professional advisors that Thoughtful Money endorses, these are the firms you see with me on this channel week in and week out. Perhaps you'd even like to talk to Michael and Lance and their team there at RAA. You can do that. So do all of that just by filling out the very short form at thoughtfulmoney.com. And as soon as you fill out that form, the firms will be in touch with you to schedule a chat. I'm assuming at this point, Michael, probably early in 2026, correct?
That would be my guess. I'm going to the Dominican Republic on Sunday, so it's not
How
going to
are
be
you?
me calling you back.
Nice. Are you going to just be sitting in the sun drinking pina coladas?
That's the plan.
All
We'll
right.
see.
All right. Well, look, I hope you have a great tan the next time I see you.
That's the goal too.
All
Um,
right.
yeah, well, Happy New Year, and look forward to catching up in January.
Same to you. And I just mentioned, or just remembered, I forgot to mention one thing. Maybe because of or in spite of our discussion about everything that's going on in silver, our Thoughtful Money's precious metals endorsed provider, that's Andy Schechtman's firm, Miles Franklin there, they still have some remaining supplies on the exclusive offer that they've made available to the Thoughtful Money audience, which is you can buy, despite silver continuing to just skyrocket in price, you can still buy from them junk silver at $1 under spot. And so if that's something you're interested in doing, then go to thoughtfulmoney.com/buy silver to take advantage of that promotion, just fill out the very short form there, and then Andy and his firm will be in touch with you right away as well. All right, Michael. Well, look, yes, right back at you, buddy. Have yourself a wonderful New Year's, and I look forward to seeing you back on this channel early in 2026. And I look forward to seeing you in Houston in just a few weeks.
Right. Take care. Thank you.
All right, Michael. You too. Everybody else, thanks so much for watching.
If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of what it's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So And it's gold and silver. Gold, if you use the CPI, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid 80s, all of his models stopped working. And he was wondering why. And he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and used what he uses for this alternate CPI is the government numbers from World War II to 1982, the method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad, it seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in an airport. Oh my God, it's just unbelievable. So,
yeah,
gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver, just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
Pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CP line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve. And they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing. But you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been, I can buy so much more real estate, stocks, just about everything I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100. 200, that still would not, compared to those other financial assets, that 200 wouldn't be in a bubble. The CPI, the current one, the low CPI is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400, and people changed their preference in late '79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year. Right? Gold is killing it. In fact, Bitcoin is 13% below its peak. Right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price, but he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America, and that's what you're seeing in the gold market. And I'm sure that mentality still exists today, the same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Russia, China, and now India. You know, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system.
The trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by. I don't. $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond.
Central banks, especially in India, Russia, China, and other global South nations, are boosting gold reserves while cutting U.S. treasuries, marking the first time since 1996 that gold has surpassed treasuries. India alone has reduced its T-bill holdings to $227 billion, while raising gold reserves to about 880 tons. Meanwhile, Eric Jung predicts that with gold hitting record highs above $3,500 to $3,600 per ounce, forecasts project $3,700 to $4,000 by mid-2026 and potentially $5,000 plus if Fed independence is challenged and a wider shift from treasuries accelerates. So the U.S. can revalue its treasury gold reserves at much greater market levels. Eric Jung is a financial commentator and analyst who frequently discusses gold, silver, and macroeconomic trends. He highlights that gold consolidated for months before breaking above $3,500, while silver pushed past $40. Many dismiss the idea that Trump's tariff threats explain this move, since that narrative has been recycled for months. What really drove the breakout was the recent BRICS meeting and India's shift, reducing U.S. Treasury holdings while increasing physical gold and silver. Combined with America's ballooning $37 trillion debt and talk of confiscating frozen Russian assets, these pressures pushed India further toward hard assets and away from treasuries. This reflects a much larger global trend. Countries like Russia, China, and now India are abandoning U.S. treasuries and adopting physical gold as a reserve asset, signaling a fundamental change in the financial order. Unlike treasuries, which can be frozen or seized by Washington, physical gold held at home cannot be cancelled by a foreign government. Eric believes as a result, sovereign demand for gold is accelerating. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
Gold, I think, consolidated for around 5 to 6 months, and it broke out of 3,500, so $3,500 US dollars per troy ounce, and silver went beyond $40. I think that was the top it made several months ago. So it's now above $40 US dollars per troy ounce. And I know the mainstream narrative of all this is that the tariffs, the Donald Trump tariffs, potential tariffs on gold and silver is not clarified, but I don't buy that because they've been using that narrative for over 6 months. How stupid do they think the authorized participants are? The bankers are, right? This is ridiculous. I think what really happened is BRICS happened, like that BRICS meeting that just happened, and what happened in India. I don't know if you know, Danny, but the Indian central bank is now reducing their U.S. Treasury bonds and T-bills holdings and increasing gold, physical gold, and guess what? Also silver, physical silver holdings. Okay, that's why I think, in my opinion, that's why gold and silver broke out of their trading ranges. Donald Trump, but it's funny that it just seems that nothing that India does pleases Donald Trump. And Donald Trump came back with a 100% or more tariff on India. So I don't know. I think it's as simple as that. It's just like somebody is trying to be nice to Donald Trump, and Donald Trump instead slapped additional tariffs on that country, and therefore that country is pushed over the edge. And now, they are reducing officially their U.S. Treasury bond holdings. But I think the underlying reason, Danny, is we've said this before. Two things. Number one, look at the U.S. national debt, $37 trillion and counting. $1 trillion of additional debt every 3 to 4 months. Okay, so this ain't gonna stop. Number two, recently the EU is supposedly potentially going to be pushing the button to confiscate the frozen Russian assets. Okay, that they froze, when Russia started that special military operation in Ukraine. So I think combining all these different, factors just really gave India the extra push to push that button to let go of the U.S. Treasury bonds and T-bills and dive in officially into gold and silver. Then recently, gold just shot up and exceeded U.S. Treasuries. So I know a lot of people make fun of this, but what that tells me is that led by the global South, Russia, China, and now India, um, you know, uh, global South countries and non-US I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system. Because going forward, I don't see there's any, significant steps of this trend in reversing. Simply because in a multipolar world, physical gold is not controlled by any individual country. Nobody can just push a button and cancel the physical gold that, let's say, India, China, and Russia hold at their, domestic vaults. Okay, but let's say if you hold a lot of U.S. Treasuries and you piss off Uncle Sam, somebody like, I guess Bessent or Jerome Powell, whoever, can go back to the office, push a button, and buy. Your stuff is frozen, or worse yet, it's going to be confiscated or deleted or whatever, right? So I think, like I said, the flight to physical gold at a sovereign level is not going to stop. It's simply going to accelerate. And physical gold, like Francis was saying, is just at its beginning phase of being remonetized. And it's going to accelerate going forward.
Francis Hunt, known as the market sniper, along with Eric Jung, points out that central banks remain steady net buyers of gold, with India notably reducing U.S. Treasury exposure while increasing its gold reserves over the past year. Analysts warn that even modest reallocations from treasuries into gold, potentially in the hundreds of billions, could drive prices sharply higher, given tight liquidity and the outsized impact of institutional flows. Forecasts suggest gold could reach $3,700 by end 2025, around $4,000 by mid-2026 in base cases, and near $5,000 in stress scenarios, expanding its market cap from roughly $24 trillion to over $31 trillion. This shift is driven by geopolitical tensions, rising U.S. debt, and concerns over dollar-based assets being frozen or seized, making gold the preferred non-sovereign reserve asset as nations diversify away from treasuries. Let's just get back to the interview.
What percentage of that is losses in treasuries as well and gains in gold, which further eggs the point rather than saying that there's no one selling. But people don't like to accumulate an asset that is losing value, and they double down and accumulate assets that for the extended future they see as accumulating value. No one gets fired for buying gold or for hiring McKinsey, they used to say. I don't think central bankers, and it also puts something else. I'll throw two other thoughts in on that chart, which I love, and I'm glad you shared it. I saw it as well. There's no chart for it, but I can tell you those nations that are accumulating and also seeing appreciation in their gold whilst not adding to their treasuries and watching devaluation, they're also not choosing Bitcoin. They're choosing gold. They're choosing gold predominantly here. And that tells me there's a very Americanized probable stigma in terms of the potential creation, because there's been no embracement by institutional central banks in the Deep South or the Grand South or the Global South and the BRICS nations in terms of Bitcoin on a meaningful basis. They accumulate it where they have a criminal who's trading in stolen cars or something, right, fine, and they hold it. But there's not a net accumulation on that side as well. So I think when you look at the big money that knows, the big money has spoken and the winner is gold. And the appreciation will be far more safe in a less volatile way, and you won't have to watch an 80% cycle deval or 75% one if you miss the perfect selling point either. And people need to remember those key aspects about Bitcoin and gold, and why I think gold is the winner. It's the safe hands for everyone. Yeah, in terms of the market cap as well, again, because don't forget $1,500 extra on the gold ounces. That's actually in percentage terms from 3.5. It's almost like another 50%. It's probably around whatever, 35 to 40%. So you would go from 24 trillion plus another third. You'd add another 8 trillion on that, and you'd be at 31 trillion. So I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond 50 and beyond. Eventually, my feeling is that whatever the debt market was at its high point, the amount of money we felt existed at its biggest bubble of the debt market, we end up seeing that deflate. And by however much that deflates, gold goes up, because there's really only one trade for me. What do? You don't buy real estate that's already leveraged with debts at ridiculously high prices. You don't chase a hyper overvalued record PE stock market. Some people will, and there will be elements. But when this is fully played out, the natural approximate geometry is however big the trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by.
The accelerating move by central banks, especially in India, Russia, China, and other global South nations, away from U.S. treasuries and into physical gold signals a historic reshaping of the global reserve system. With gold breaking record highs and forecasts pointing toward $4,000 to $5,000 in the coming years, the metal is regaining its role as a core anchor of financial security, driven by sovereign demand, geopolitical uncertainty, and distrust of dollar-based assets. Could a mass revaluation of U.S. Treasury gold reserves at higher market prices fundamentally reset the global financial system? How might continued BRICS diversification into gold and silver impact the long-term dominance of the U.S. dollar? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.